In the summer of 2007, magic is currency. Harry Potter and the Order of the Phoenix hits global theaters with the force of a cultural earthquake. The theaters sell out in Tokyo, London, and New York. The merchandise flies off the shelves. The box office numbers are staggering, funneling cash into Warner Bros. Accounts at unprecedented speed. Within weeks, the film grosses $938 million worldwide. It becomes one of the highest-grossing movies ever made. Audiences cheer, executives celebrate. The Boy Who Lived is an unstoppable financial engine, a pure license to print money. And yet, beneath the surface of this historic triumph lies a mathematical impossibility. 3 years later, a piece of paper slips out of the corporate fortress. A leaked 2010 net profit statement printed in cold, black ink. According to Warner Bros., Harry Potter and the Order of the Phoenix did not make a profit. It did not break even. According to official corporate accounting, this $938 million juggernaut officially lost $167 million. This is not a tax error. It is not an unverified allegation. It is a documented, legally binding reality inside the most profitable industry on Earth.
How does nearly $1 billion disappear into thin air? The answer is hidden in a parallel universe of private math, a system designed by the entertainment industry parent conglomerates to absorb billions in real cash while ensuring their biggest cultural assets technically never make a dime. The theaters collected real money, the fans paid real cash, but the parent company transmuted that gold into lead on the official ledger. This is the anatomy of a shadow ledger. It is a mechanism of pure institutional power, designed to protect the corporate treasury from the people who actually built the product, turning a global phenomenon into a documented catastrophe.
To understand how $1 billion vanishes, you have to understand the currency of Hollywood. It is not just cash, it is leverage. For decades, studios faced a persistent problem. Writers, actors, and directors wanted a piece of the upside. If a movie hit big, the talent wanted a percentage of the profits. This is known as the back end, or net profit participation. It sounds like a fair partnership. The studio takes the financial risk up front, and if the film becomes a blockbuster, the wealth is shared among the creators. But institutions do not give away equity if they can engineer a legal way out of it. The modern studio system did not invent Hollywood accounting, but they perfected it into a weapon of mass extraction. The mechanism is simple, yet completely invisible to the public. When a major conglomerate greenlights a tentpole movie, they do not just make a movie. They create a temporary corporate shell, a bespoke financial entity designed specifically to absorb costs and deflect revenues. Harry Potter and the Order of the Phoenix was not just a film, it was an isolated financial container. History is littered with these phantom failures.
Return of the Jedi made $475 million at the box office, yet Lucasfilm famously claimed it never went into the black. Forrest Gump pulled in $677 million, but Paramount ledgers showed it was a financial loser, prompting a bitter lawsuit from the original author. Batman grossed $411 million, but Warner Bros. Cited a massive deficit to avoid paying out net points. The blind spot of the general public is the assumption that box office gross equals studio profit. The reality is a labyrinth of internal fees. The parent studio acts as the bank, the distributor, and the landlord. It charges the film rent to use its sound stages. It charges the film interest on the money it lent itself to make the movie. It charges a massive distribution fee to place the film in theaters. The parent company pays itself, moving money from its left pocket to its right pocket, while officially recording the transaction as a devastating expense on the film's isolated ledger. The cash never leaves the corporate building, but on paper, the film is bleeding out.
By the early 2000s, this system was an open secret among elite agents and entertainment lawyers. Yet the scale of the extraction remained hidden. The general crew, the supporting actors, the screenwriters were still signing contracts promising them a percentage of net profits. They believed the math was real. They believed a global hit meant a payday. They were signing up for a percentage of a mirage.
The system was never designed to share the wealth. It was engineered from the ground up to ensure there was technically no wealth to share. The architects of this system are not rogue accountants. They are the chief financial officers of the world's largest entertainment conglomerates. Their core motive is fiduciary duty. They are legally obligated to maximize shareholder value, and paying out tens of millions in back-end bonuses is viewed as a direct threat to the bottom line. So they engineer a contractual firewall. Inside Warner Brothers, the strategy for the Harry Potter franchise was absolute control. The stakes were astronomical. This was a multi-billion-dollar cinematic universe. Every single percentage point of profit was worth millions of dollars. To protect this wealth, the studio divided its partners into two distinct tiers. The top tier consisted of the untouchables: J.K. Rowling, David Heyman, and eventually the lead actors like Daniel Radcliffe. These players had the immense leverage required to demand gross profit participation. Gross points are taken off the top, immediately after the theaters take their cut, before the studio's magical accounting can apply its endless deductions. If the movie makes $1, the gross participant gets their cut. The studio cannot hide top-line revenue.
But the second tier was everyone else. The supporting cast, the writers, the thousands of visual effects artists and crew members who brought the wizarding world to life. Their contracts often included net profit points. The promise was simple: help us build this empire, and when we are in the black, you will see a check. This is where the motives of the institution clash violently with the reality of the workforce. The studio incentive is to artificially inflate the expenses of the film's isolated shell company to ensure net profit is never reached. The accounting department is tasked with a specific objective: to find every conceivable way to charge the production. The movie is treated not as a beloved subsidiary, but as a hostile debtor. The studio loans the production the budget, but charges an exorbitant interest rate. The parent company is the creditor, the vendor, and the judge. The motive is not personal malice, it is corporate efficiency. Why pay a supporting actor 5% of the net profits when you can legally prove the net profits do not exist? The executives sitting in Burbank knew exactly what they were doing.
They were playing a high-stakes game where they wrote the rules, owned the board, and kept all the pieces. The ledger was merely the instrument of their strategy, ensuring that the wealth generated by the many was consolidated into the hands of the few. In 2010, the impenetrable fortress of Hollywood accounting suffers a rare and devastating breach. A net profit statement for Harry Potter and the Order of the Phoenix is leaked to the press. It acts as a Rosetta Stone for institutional extraction. The document reveals the exact anatomy of the shadow ledger, exposing the precise mechanisms Warner Brothers used to drain a Blockbuster. The top line is undeniable. The film grossed $938 million worldwide. The theaters take their cut, leaving hundreds of millions in receipts. But as the eyes move down the leaked ledger, the extraction begins in earnest. The first major blow is the distribution fee. Warner Brothers charged the production $212 million simply to distribute the film. This is not the actual cost of marketing. This is not the cost of printing film reels, shipping drives, or buying billboard space. Those are entirely separate line items. Advertising and publicity cost another $131 million. The $212 million charge is a pure toll booth fee. Warner Brothers is essentially charging its AIM movie a massive tax for the privilege of being a Warner Brothers movie. The parent company pockets the $212 million as real revenue, while the film Isolated Ledger sinks deep into the red. But the corporate extraction does not stop there. The ledger reveals an interest charge of $57 million. When Warner Brothers greenlit the film, they provided the $150 million production budget. But they did not treat it as an investment in their own property. They treated it as a loan to the film's shell company, and they charged an aggressive, compounding interest rate. The $57 million is phantom interest. No money changed hands with an outside bank. Warner Brothers paid itself $57 million, logging it as a devastating financial expense for the movie. The math becomes a weapon of mass erasure. Gross receipts of $938 million. less the theater cuts, less the $212 million internal distribution fee, less the $131 million for advertising, less the $150 million production cost, less the $57 million in internal interest, less the gross participations paid out to the untouchable top-tier talent. The final calculation lands with a heavy thud. Negative $167 million. The film is officially a massive failure.
The mechanism works flawlessly. The moment this statement leaks, the conflict explodes into public view. The curtain is violently pulled back on the industry's most lucrative open secret. For the workers holding net profit contracts, the realization is chilling. They are holding worthless paper. They negotiated in good faith, believing a billion-dollar blockbuster would secure their financial future. Instead, they are staring at a documented ledger that proves they will never see a dime. The tension ripples through talent agencies and law firms across Los Angeles. Lawyers advise their clients that net profit is a fictional concept, a phrase known cynically in the industry as monkey points. The studio defends the practice. They argue that they take all the financial risk. If a movie bombs, the studio absorbs the true loss. Therefore, when a movie hits, the massive internal fees are justified to cover the cost of the failures across their broader slate. It is a portfolio strategy. But the sheer scale of the internal charges on Order of the Phoenix strains the absolute limits of credibility. Charging $212 million in distribution fees on top of $131 million in actual marketing costs is an act of sheer institutional dominance. The studio is not just covering its risk, it is aggressively preventing the triggering of net profit clauses. The leak forces the industry into a stark reality. The divide between the elite talent who can demand gross points and the working class talent stuck with net points becomes a permanent canyon. The system is operating exactly as designed. It is a masterpiece of corporate engineering, turning a global cultural phenomenon into a documented catastrophe to protect the treasury from the creators. The $167 million loss of Harry Potter and the Order of the Phoenix is not merely an accounting quirk. It is a monument to a larger, quieter truth about institutional power. The entity that writes the rules of the ledger controls the reality of the outcome. In the modern economy, reality is not what happens. Reality is what can be legally documented. Warner Brothers did not break the law. They wrote the contracts. They defined the terms. They built the mechanism. The entertainment industry private accounting rules allow parent conglomerates to absorb billions in real, tangible cash, while their biggest cultural assets technically never make a dime. This architecture of extraction exists far beyond Hollywood. It is the exact same logic used by multinational corporations shifting profits to offshore tax havens, claiming poverty in the jurisdictions where they actually operate. It is the same mechanism used by private equity firms loading acquired companies with impossible debt. It is the weaponization of complexity. When the math becomes too dense, the public looks away. The workers accept their wages, the fans buy their tickets, and the parent company quietly moves the capital into the vault. The people who built the wizarding world, the artists who spent years crafting a billion-dollar dream, were left holding contracts tied to a deliberate illusion. The shadow ledger ensures that the house always wins, not by cheating the game, but by owning the definition of the score itself. The leaked document from 2010 remains a rare glimpse into the engine room of modern corporate strategy. It proves that a blockbuster can conquer the globe, define a generation, and generate unprecedented wealth, while officially remaining a catastrophic failure. If $1 billion in revenue cannot guarantee a profit on paper, what does a promise from a massive institution actually mean?